Mike's Investment Lab, and today, my take on a max growth portfolio. So I won't beat around the bush too much and jump right into the portfolio. So if you can refer to the previous video talking about the low volatility versus the conservative balanced portfolio, I will say this time around things are a lot more apples to apples. This is a growth portfolio being compared against the S&P 500. So if there's anything that's not necessarily aligned, it's the fact that the S&P 500 is 100%. Don't ask me why it says 0.39 international, but it's 100% US as it tracks the top 500 companies in the US. So we're looking at US equities also in Canadian dollars. So there's a couple limitations, but honestly, I'm going to say a pretty good apples to apples comparison. So you can see here the portfolio that I have concocted. Next to no bonds in here, a little bit of other not classified, but really this is a growth portfolio. It's a bunch of different stocks. We have 272 different stocks. We have 6 different bonds. Bonds are just happen to be within one of the portfolios that we're using. So anyway, looking back, I do have, once again, grievances going back too far because some of these portfolios have only existed for the last 5, 7, 8 years. So looking at a 10-year history, for example, might not necessarily be an accurate representation of what this could have done. But I'm going to say from 2020 onwards, we have some pretty good history we can look at. So number one, the 5-year return looks fantastic, 27.5 versus the benchmark of the S&P 500 at 17. So I would never tell anybody to expect a return of 27.5. I don't even think I could tell somebody to expect a 15% rate of return. But what I can say is that this portfolio concoction has outperformed the S&P 500 over the last 5 years. I think that's evident. Looking at calendar returns year by year, so far this year, it's beat the benchmark by over 20%. Last year, beat it by about 5. Year before that, beat it by 26. But 2022, my gosh, it did not do great. We were talking about almost negative 30. So the main thing I want to kind of put out there here is this is a max torque, balls to the wall kind of strategy. And there are definitely stocks, there are definitely investments that dropped that much in 2022, evidently here. The S&P 500 did fall. It fell, as you can see, about closer to about negative 14%. But there are definitely stocks in the S&P 500 that fell by more. So just be aware. This could fall, and it's probably going to fall a little bit harder. One thing I do like is when we look at the actual breakdown of the portfolio, the benchmark has a very high tech sector, a very high tech allocation, which makes sense if you've heard before. The Magnificent Seven make up 37% of the stock market. So, yeah, that's 7 companies dominating one index, kind of crazy. But the good news is here is, yes, they're still very tech heavy, not nearly as tech heavy as the overall market. And I will say also that, and I realized too down here in the holdings, I blurred those out, but a lot of the tech funds that are included in there, it's not all tech funds by any stretch, but the ones that are, we're actually down by more than negative 28, like some of them closer to negative 30, and also delivering returns less than the 27.5. So I think, yeah, it sucks to see that kind of a drop, but I do think for the level of risk that's being taken on, there's been a lot of synergies that have been found here. Let's just put it that way, maybe. Let's go a little further down. Of course, I like looking at the Sharpe and Sortino ratio as measures of risk, looking at the last 1 year, looking at the last 3 years, looking at the last 5 years, and looking at the last 10 years. Once again, I take a little bit of grievance with the 10-year because you're going to see real quick, only 2 of the funds actually existed 10 years ago. So, looking at the 5-year and the 3-year and the 1 year, this portfolio has beaten the market quite consistently. Also interesting to note, looking at the upside and downside capture ratios, which I always like to do, portfolio upside, anything above 100 means that this portfolio over the last 1 year, for example, would have had about 73% more upside than the overall market, while only having about 2% more downside. So evidently here, every single year over all these time periods, it's had just as much downside as the S&P 500. So investing in something like this, be prepared for market level returns and market level drops as well. But furthermore, maybe even slightly more than that. Importantly though, on the upside, we're always seeing, at least historically, a greater portfolio upside than a portfolio downside. So generally meaning for the level of risk you're taking on, you're being compensated accordingly, which I think is a good thing, and most people would agree with me. This is, once again, I'm not showing you the funds, but you can see one of the funds hasn't even existed for 5 years, but I will say its 3-year return, 55%, is freaking fantastic. But looking at, there's 2 funds in here that have had 10-year returns. The rest of them have not. So obviously, I think the 5 years is going to be a little bit closer to reality for that, because if we go 10 years back, it's quite literally going to split the portfolio between these 2 different stocks, or 2 different funds, which is not a fair representation of this portfolio whatsoever. Other than that, once again showing you, that's that one fund with a 3-year history, no 5-year, a couple ones with 5-year and a couple with 7, one with 6, or 8 rather. But with that all being said, I'm not actually recommending this portfolio right now. Not in its current form. And the reason for that, maybe I'll stop presenting here. But the reason that I'm not actually recommending this portfolio right now is the market feels a little high. And obviously I don't have a crystal ball. I don't know what the future holds. If I did, I would be a very wealthy man. But they say the future doesn't repeat itself, or the past doesn't repeat itself, but it often rhymes. And I think that this feels a lot like 2021. And the market could continue to rally. It definitely could. This tech stuff could continue to do great. But I'm really hesitant to advise somebody to jump in right before it drops. And a lot of this stuff dropped by 40 to 60% in 2022. So I also don't think it's wise to just sit on cash, because I could be wrong. A lot of these people thinking the market's going to drop could be wrong, and the market could continue to rally. So what's the happy middle ground? Where's the nice spot to sit for right now? If you can refer to my video from a couple days ago, my approach to the low volatility conservative-ish portfolio, that's where I'm recommending a lot of people are parking some of their money right now, because I believe that yes, if we saw a down market, that portfolio might get beaten up a bit, but historically it has bounced back really quickly or not gotten beaten up at all. So with that mentality, if somebody does think that the market could fall in the next little while, somebody like myself, investing in something with a lower volatility and then switching if the market does fall might be a prudent decision. You'll see too, I'm going to get into a couple other portfolios that fall between my low volatility and this max growth, because I find for most people the happy medium is somewhere in between. But for today, I hope that you found this interesting. Please send all business inquiries to nixinvestmentlab@gmail.com. And as always, please like, comment, subscribe, and tune in for future videos and see what we have to discuss. So, as always, thank you so much, and look forward to catching up with you again soon.